We are in the middle of quite the roller coaster ride when it comes to stock trading, session after session. How do you think investors should be handling this ride?
This is a pretty difficult time, I think, to navigate as an investor because, your emotions are so high. We see, sentiment figures have been taking a real nosedive here. Volatility has been elevated. The market's really unwound pretty quickly here in about 3 weeks, a little less than a month. So, it's been difficult, but at the same time, I'm hesitant to get too cautious, especially after such a quick pullback. These types of pullbacks are actually pretty normal. It's easy to say that, but it's kind of hard to go through because the emotional toll is pretty high, especially for investors who are, actively involved in the market or checking their portfolio often. But the market averages three pullbacks a year of 5% or more. The average intra-year dip over the last 50 years is about 14%. So we're still within the range of normal. That doesn't mean there aren't concerns. It doesn't mean things can't get worse. But so far, it's not as wild as it may seem.
Okay, so then for investment opportunities in this kind of market, what do you see?
Well, I think when we kind of zoom out and look at the market, it's a reminder that diversification can really help shield your portfolio and sort of shelter the emotional toll that the volatility can bring. When you look outside of equities, you have bonds are still up on the year. You have gold up 10%. Even coming into this week, 9 out of the 11 S&P 500 sectors are still positive on the year. That number's gone from 9 down to 7, albeit barely. But really, the pain has been felt in tech and consumer discretionary stocks. Tech's down 9% on the year. Consumer discretionary is down close to 13%. These are not only big weightings in the S&P. Tech accounts for about 30% of the index, but they're big weightings in investors' portfolios. These are their favorite stocks, their favorite names. I bet most investors can name, the top 5 tech stocks. Probably can't name the top 5 material or energy names, some of the other groups out there. So, that pain is really being felt in those groups specifically.
All right, we got some data today, initial jobless claims, another report on inflation, PPI. I want to hear your take on these reports.
For me, the big number I was watching was jobless claims. There was this, when we came into the beginning of the year, there was a concern around inflation and sort of reflationary trade taking hold. And that was where investors were really focused, and that focus was misplaced. And that's clear in hindsight. But now the real focus is the real worry is on jobs and the economy as a whole. So, for me to see the jobless claims number still kind of muted, coming in below expectations, that was important, I believe, for the market to see, give a little bit more relief. The JOLTS number the other day was, again, a little bit more reassurance, but we really need to see that monthly jobs number start to come in a little bit stronger, really shrug off those worries.
You've said historically mild inflation is good for the market, but what are your thoughts about tariffs in the mix and the impact of all that uncertainty and the tax that consumers will ultimately have to pay, for consumers? What's your take on that?
Yeah, the tariff situation is so difficult, if not for the simple fact that it changes on sometimes an hour by hour basis. It's very difficult to get a feel and a hold on how tariffs are going to impact not only the big macroeconomic numbers like inflation, but how it's going to affect people on a day-to-day basis. Are consumers losing confidence because of inflation? Are businesses losing confidence because of it? And I think we're seeing that toll taking a hit on the market, but it's a question of how long these stay in place and how that will impact the market moving forward.
We're hearing some big names use the R word. BlackRock's Larry Fink yesterday in an interview saying, "I hear that the economy is weakening as we speak." Do you agree?
Yeah, it's really hard to say this early on into. I mean, we got to think a couple months ago we were in a very strong, much stronger position economically and market-wise. But there is this concern, and when it comes to the economy going into a recession, and that permeates from everywhere from a C-suite down to the consumer. If the consumer starts to hear that and get the feeling that we are moving towards a recession, maybe that's directly impacting them. Their hours are being cut, or maybe it's indirect. They're just seeing it in the news, but that affects their spending decisions, and that trickles up pretty quickly to consumer discretionary names, to retailers, and we're seeing some of that come out of airlines are coming out with bad guidance and poor updates. So, that is the big worry at this point. But I do think it's maybe a little too early to jump to that conclusion.
All right. My thanks to you, Bret Kenwell, U.S. investment and options analyst at eToro. Thanks for your time today.
Thank you.